Good morning, everybody. It is Tuesday, February 16th. This is the option selling call, and we have quite a lot to look at. As you know, over the last several months, I've used different screeners, and I finally have settled on using the screener at TradingView because it does something that I like to have done, which is pull up the weekly relative strength index and money flow. So if you have TradingView, even the free version, you can do your charting by any time frame from 1 minute out to a month. And as we've learned, the weekly charts are the ones that give the most accurate signals. Now, you might be a week early or 2 weeks late, but you're generally going to be pretty close. So when you take a look at things like relative strength index and it gets above 70, you know that something is overbought. So we take a look at PTC here, which is a recommendation quite a long time ago, and we talked about this. I drew this chart for you 2 weeks ago, I believe, of where PTC could go. And as you can see, it's at this point on this line right now. So the question becomes, is it going to chop this way and get to this level because it looks like it's breaking out, or is it going to get up here? Or is everything that's going on right now a false breakout? The S&P 500 is at about 35 right now. And one of the things I wrote about a month ago was that, we could see 4,000 on the S&P 500 because it's a round, shiny number, and people like round, shiny numbers. So we could see the stock market go up several more points, get into, just over 4,000 on the S&P 500, 400 on the SPY, which would drag a lot of these stocks up to these 1.618 levels. And we're going to see this in a number of different companies. So with PTC, if you own it, like I said last week, you should trim some of it, but then you can also write a covered call that would give you a net price after sale with premium of about 170. So if we take a look at our handy dandy Yahoo, which is the fastest, easiest way to do things usually, it's remarkable that it's faster than my brokerage accounts. As you pull this up and you say, okay, PTC, we want to net out $170 a share if we can, or just take some premium in. And we see, okay, well, the 160 gets us about $2. So if we got called away at 160 and had another $2 built in, it's not that big of a deal. But the question you should be asking yourself is just how much should you be selling in the first place, or should you be selling two covered calls, one right at the money and then one a little further out? And that really is going to depend on your risk tolerance. But trimming and then selling a covered call a little way out, or setting a price here of like $7, $8, $9, so that if it does rally, it just triggers at $7, $8, $9, because we know that 174 is probably a pretty strong resistance level, come back down to you. So it's just a matter of trading this range for now and wondering, as liquidity in the markets tighten up, are we going to see a correction down into the buy zone? And I suspect that we will. I don't know if we'll get under this 109 area, but I do think that's probably, to me, a target that will happen. It's just a matter of when. And again, remember, a lot of this is driven by excess liquidity. And as we looked at in a webinar, again, I think 2 weeks ago, excess liquidity is slowly coming back to normal, slowly. And the thing that's going to happen a few months out, which means the market will start to anticipate it, is that the Treasury is going to have to issue $2 trillion in bonds that the Fed isn't likely to buy. I mean, unless the Fed triples its monthly purchases, I don't see that happening. If it did, it would be potentially very problematic for inflation. So the question becomes is, how is the United States government going to finance $2 trillion, which is basically this stimulus bill, so that we can jumpstart the economy? And I think the answer lies in the Middle East. I truly do. We know that President Biden would like to see the oil industry here contract, but provide us enough security so that we don't go back to being dependent on the Middle East. But he wants to see a clean energy transition. So having oil prices in the 70s, or maybe even pushing 80, I don't think will break his heart. The problem is that oil prices any higher than they are now could hold back the economy. So we have this cold snap. We have a stimulus bill coming. I think that there's a very good possibility that you see some sort of agreement with Saudi Arabia that, hey, we'll buy a little bit more oil from you. Go ahead and add a couple million barrels a day. Keep that price in that 60-something range so that our drillers don't try to drill more. You can have that money. Just buy some U.S. treasuries with it. And I think that some sort of a quid pro quo deal like that is very likely. We already know that it's the direction that the administration wants to go. So you should probably expect oil prices here to be pretty much capping out in the not too distant future. This cold snap won't last much longer, another week or two probably. I've looked at the long range weather forecast. A couple of weeks out, North Texas is 60 degrees again. So, you start taking a look and okay, how do we make sure the price of oil doesn't stunt a recovery? We tell Saudi Arabia to pump a little bit more, otherwise we will. If you'd like to pump it, Saudi Arabia will, hold back through regulation some of our drillers. Just buy some U.S. treasuries. Let's make sure that the petrodollar has a little bit longer life and go from there. And within a year or two, we're going to have a digital dollar that kills Bitcoin. All these things play into what these charts are doing because they can drain some of this excess liquidity out of the market pretty easy through treasuries. Go back to your screener. Just want to show you something. You go to the filters here and you tell it, take that back. You take your watch list and you flag it. So you flag your watch list, which is on a different page. Whatever. Find your watch list, create flags, and then you tell your screener that you want to see the flagged ones, right? So just click that right there. It pulls all the flagged things in your watch list to the top, and then you can rank it by whatever you want to rank it by. So this stock screener at TradingView is hands down the best one for technicals. I haven't seen anything like this. I didn't know for months that it even did this. So I think that at a minimum, you should have this TradingView. If you're serious about trading options, selling options, you need to have this because it is a remarkable time saver. You just go, okay, rank it by RSI. Right? Everything around 70 or higher is probably a trim or sell a covered call. You see some of the oil names in here, Occidental. So Occidental announced massive losses again, and the stock is still almost overbought. A lot of these things are temporary situations. Let's take a look at Nutrien because that was a pretty big holding for us. It's at this 2.618 line. I think is probably not going to break out just yet. We could even go back here. This is your breakout line. Oops. So that's your breakout line. There you go. Will this break through here? Man, maybe. But I think that with Nutrien, if you're selling $55 covered calls right now, that's probably a great idea. I know we've talked about this one before. I don't really want to trim Nutrien because it's got the fat dividend. But if I can build in a little extra income with these March covered calls, right, the 55 or even the 60, just add yourself some more dividend, knowing that it's probably going to have a little bit of a retracement before it breaks out. And I don't know that I expect this breakout until late this year, early next year. I'm looking at liquidity numbers now, and I read a couple of articles from a couple guys on Seeking Alpha. The one article by Rita Mora, who just astounds me. He's so popular because he's so bad at what he says. But he was saying that the bull market is in the early innings. If it is purely liquidity driven, and you have to decide how much risk you want to take, knowing if the stock market goes up on an escalator and it comes down on an elevator. Look how fast that happened. So you have to decide how important is it that you chase another 5 or 10 points of return versus, are you afraid of the elevator drop? And that depends on you, right? If you're younger, you're less concerned. If you're older, you're more concerned. Micron, there's tightness in the semiconductor market. This could rally all the way up to 100, which is something that I said 4 years ago, 5 years ago, that it would eventually get to 100. This might be the rally that takes it there, but I'd still be trimming and selling some covered calls on part of your position. I know some of you have big positions in this one. Again, depending on your risk tolerance, but trimming a little bit right now and writing a covered call out here makes a lot of sense, especially since I bet you're going to get a pretty big premium on these. So the April, you get 3% on a $100 call. If it gets called away from you at 100 for a net price of 103, does that break your heart? Probably not. But you're taking a 3% dividend right now, right? Same thing with Freeport-McMoRan. This one could break out, go all the way up to 50-ish. But again, this level here is important. It wouldn't be unusual for it to jitterbug around here, in which case the time value of the covered calls that you write, right, moves towards expiration. So writing a covered call at, say, 44-ish, and I'm going to guess 44, 45. Let's take a look. There's your April. Not much out here. Yeah, I probably just trim a little bit of the Freeport just because you've had a big rally. I know some of you bought it in the teens. Then you have to decide, do you want to write some covered calls out here? And I think at this point you could go out to April. I won't go any further than April. $1 for the 40s. That's all right. I'd probably just trim a little. These options don't look real attractive on Freeport. And then here's one. So I showed you this chart last week. I said it's at that point where it can break out. Well, it broke out. Why? Here's why. So this is something that I think was forecastable. I talked about it when the stock was in the low 30s. It's suddenly 40 today. And if you sold the cash secured puts, I don't know that you really need to buy them back in because they're probably just going to expire. But if you have other cash secured puts and you need to free up the cash, you can certainly do that. Yeah, so Rack says that my retirement portfolio was damaged by Rita Mora recommendation. So Rita has now hooked up with Avi. And, Avi's a pretty good technical analyst. So I think Lynn Alden's not a big deal. Doing her research online and kind of echoing things that other people are saying. Things that Lynn says today are usually things that I said a year or two ago. So when I'm telling you today that you're probably going to see the dollar rally sometime in the next year, what's she telling you right now? The dollar is going to crash. Well, I showed you the dollar chart, right? Don't be impressed by people who pull up a Fed chart and tell you what's happening right now. Big deal. Tell me what's going to happen in a quarter or a year. That's where the value is. So I told you this one was going to break out. I showed you why. And now it's breaking out. Here is the headline that drove it. If it comes back here to 33-ish, you might get lucky and get it a little lower. You probably sell more cash secured puts if it pulls back down to this yellow line. So another one that you should probably, again, should be taking your profits. It's gotten to the 2.618 line. Interest rates are low. I do like Invesco as a firm, but I wanted to buy it down in here, in this yellow box. And now it's had this rally. And you have to ask yourself the question, how much upside is there in a market that is consolidating, but fees are going down? You have consolidation expenses. BlackRock's kicking everybody's ass. I think it's hard to be an Invesco at this point, given that we don't know if this is going to break out. So I'd be dumping 2/3 of my position. I wouldn't even necessarily be writing covered calls now. I had to write some covered calls a little while ago. It's at this line, 2.618. That is generally a spot where a stock retraces. Now, if you wanted to buy it back again in the upper teens, I could see that. But I just don't know if there's much upside here, given that these companies just aren't making a ton of money anymore. That's why they have to keep buying each other, and they take on debt to do it because everybody's CEO needs to get a bonus. It's not that high on IBZ anymore. What can we sell a cash secured put on? You take a look at the RSI and you go, well, We Energies is interesting. I think you need to be looking at We Energies. There you go. It's in the buy zone. I think this is a pretty interesting one. This company has always done well. They're going to continue to do well. I don't think you have much to worry about with these guys. So if you're a retiree and you want a good utility, I think you need to take a look at selling a cash secured put, probably almost right at the money. And one thing I'll tell you is that strike prices, one increment in or out of the money is usually where you make money. So you could sell March $80 puts on We Energies right now. In fact, I would say if you're a retiree and you're looking for utility, this is one of the best ones out there that's not 100%, clean energy focused. I think there you go. $2, 2.5% for a month. If it gets put to you at 80, I think you're gonna be pretty happy with that, right? What's their dividend? About 5% right now. Well, way down at 2.71. It's because the price is always so good. So if you got it at 80 and you added $2, right? Now all of a sudden you've essentially doubled your dividend. And if it rallies back up to here towards 100, you sell some more covered calls. So I think this is the pullback you're looking for here. I mean, could it go all the way down to 60? Yeah, I think, it could, right? It could. So let's expand that box so you know where your risk is, right? You could be a little bit more conservative. You could write a cash secured put for 80, but write the limit order at like $4 or $6, right? To pull your net costs down to mid 70s. This is pretty strong support right here at about 70. Some bad things would have to happen for it to get way down here to 60. Pull up your screener again. I told you I'm waiting on Merck. I want Merck to be much cheaper. We covered that last week. Same with Pfizer. These RSIs, there's not many in the 30s. Well, let's look at T-Mobile. That's interesting. Yeah, it's got to come down more, but this line right here. So let's do a recent chart. So this base, that base to this peak, so about 95 is probably where you want to get this one. It's closing in. I'm putting all my charts out to the end of the year because I think if there's fireworks, it'll be between now and the end of the year. We'll see how the tax law changes. I know they'd rather have the fireworks now than next year. There's a lot of political reasons why they want to have the fireworks this year. Got to get it out of the way before we're in election season again. So right there, a little under 100 on T-Mobile. And the reason T-Mobile, it's just another one to add to the whole AT&T, Verizon, if you like Verizon. It's just another place to have money in a world that's going Internet of Things everywhere. All right, any questions? Oh, Lockheed Martin's flirting with us. Again, this is a tough one to sell cash secured puts on, but I think a nibble is probably in order, right? It's down $2 again. A small nibble on Lockheed Martin, for a 0.5% of your portfolio, just get that starter position in there. I'll probably write about Lockheed Martin this week. It's just such a good company. Could it go down further? It could. But this stimulus plan is going to have something in there for them. So I think that, especially when they work on the infrastructure bill, which is going to be more bipartisan, so I think they'll get 60 votes for that. I think Lockheed Martin does pretty well. Plus, we're ahead of schedule on the shots all of a sudden, right? We've caught up. Johnson & Johnson comes to market next month. We just got another 100 million doses from out of Pfizer and Moderna by August, between now and August. I think we're going to surpass the 50 to 70% range on people who are vaccinated by the end of the year. I think we might be almost everybody 16 and older is going to be vaccinated by the end of the year, I think. That's going to be pretty good for a lot of these companies. It's why EPR, with that weird AMC connection, here's one that I think you could sell cash secured puts on too. We talked about this last week. April 45s or 40s. You get a pretty good premium. And EPR, I'll tell you what, once this country starts traveling, my poker guys want to go to Vegas in June no matter what. I just said, hey, got to give me options because I'm not going until I've had a shot, which, they're all millennials, so they think that's funny. Oh, well, yeah, you already had it. So I don't care. I'm not going back to Vegas or doing any of these trips until I've got a vaccination, especially since there's, a couple other strains. That's the one thing with the Johnson & Johnson shot. I'm skeptical of the mRNA shots. I worry about them. Maybe I'll get them in the future. But the Johnson & Johnson shot, even though it's a little lower on the efficacy, it does handle some of the various new strains a little bit better. So you kind of weigh it, where do you want most of your protection? So I'm going to probably grab J&J when it comes out. All right. Any questions about any option selling? Any stocks that you own? Nope. All right. Well, then everybody have a good day. I'm going to start editing these.